Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight. Get ready because HP Incorporated's latest report is a wild ride full of big moves and even bigger risks, kind of like a drilling rig in a hurricane. Before we dive in, if you are all about getting the real story behind corporate filings, smash that subscribe button. And hey, we've got a fantastic community over on Discord, linked right down below, where we dissect these documents together. So stick around and let's get started. Alright, let's get straight to it. Helmerich and Payne Incorporated, or HP Incorporated as they call themselves, just dropped their 2025 annual report. This filing is a look back at their financial year for 2025. Ending in September, they're a company that provides drilling solutions and technologies to oil and gas companies, aiming to make getting that oil and gas out of the ground safer and cheaper. The big headline here is HP Incorporated's massive acquisition of KCA Deutag International Limited, or KCA Deutag for short, back in January of 2025. This was a huge deal, costing about $2 billion in cash. Think of it as HP Incorporated buying a whole other drilling company to become much bigger and operate in more places around the world. KCA Deutag is a global player with a strong presence in the Middle East, and they've got land operations as well as offshore management contracts. This acquisition really shakes up HP Incorporated's business, making them a much larger, more international company. Let's look at the numbers as of the 30th of September 2025. HP Incorporated had total assets of about $6.7 billion. That is up from roughly $5.8 billion the year before. A big chunk of that increase comes from the KCA Deutag deal, particularly in property, plant, and equipment, which jumped up significantly. Their liabilities also went up, mainly due to new debt taken on for the acquisition, totaling about $3.9 billion. But here is the kicker: while total shareholder equity went up, it actually decreased slightly compared to the previous year, going from $2.9 billion to $2.8 billion. This suggests the debt taken on for the acquisition, combined with other factors, outweighed the increase in assets. Digging into the details, their accounts receivable, which is money owed to them by customers, more than doubled from $418 million in 2024 to about $782 million in 2025. This is often a sign of increased business activity, but it also means they have a lot more money tied up waiting to be collected, which can impact their cash flow. Their inventories also jumped from $117 million to $324 million, likely due to the KCA Deutag acquisition, bringing more parts and supplies into their system. Now, let's talk about goodwill. This is an accounting term that represents the excess of the purchase price of an acquired company over the fair value of its identifiable net assets. It essentially captures the value of things like brand name and customer relationships that are hard to put a precise number on. After the KCA Deutag acquisition, their goodwill soared from about $45 million to over $182 million. However, that is not the whole story. They took a major hit with goodwill impairment charges, writing down a significant chunk of that goodwill. This suggests that the acquired business might not be performing as well as initially expected, leading to a reassessment of its value. Looking at their income statement, HP Incorporated reported a net loss of $163.7 million for the year ended the 30th of September 2025. This is a stark contrast to the $344.2 million profit they made in 2024. The acquisition of KCA Deutag, while expanding their operations, clearly had a significant negative impact on their bottom line in the short term. Revenue did increase to $3.7 billion from $2.8 billion, mostly thanks to the new business, but the costs associated with the acquisition, including transaction costs and the aforementioned impairment charges, were just too much to overcome. Speaking of those impairment charges, they were a whopping $194 million in 2025. Ouch, this primarily comes from a goodwill impairment, which we touched on, meaning they had to write down the value of their acquired assets because they are not worth as much as they initially thought. This is a red flag, showing that the integration of KCA Deutag is facing some serious challenges. And let's not forget the interest expense. It shot up from $29 million in 2024 to over $107 million in 2025. That is a massive jump, mainly because of the new debt they took on to pay for KCA Deutag. This means a bigger portion of their earnings now goes just to pay interest, leaving less for other things like investing in the business or returning money to shareholders. Let's break down their main business segments. The North America Solutions segment, which is their core business in the US, saw a slight dip in revenue, down 3.4% to about $2.36 billion. Their operating income in this segment also fell by about 5%. This suggests that even their strong domestic business is facing headwinds. like lower activity levels and increased operating expenses. The International Solutions segment, which includes the newly acquired KCA Deutag operations, saw explosive revenue growth up over 300% to $802 million. However, this segment also reported a huge operating loss of nearly $292 million. This is where those impairment charges really hit hard. The massive increase in available rigs and contracted rigs, especially in Saudi Arabia, shows the scale of the acquisition, but the losses indicate significant integration challenges and potential overcapacity or contract issues. Their Offshore Solutions segment also saw a revenue boost, up almost 400% to $520 million, and managed to turn a profit with operating income at almost $50 million. This segment seems to be performing relatively well, but it is a much smaller piece of the overall pie. Now, let's talk about their backlog, which is basically the money they expect to make from existing contracts. Their backlog more than quadrupled from $1.5 billion in 2024 to a massive $7 billion in 2025. This is largely thanks to the KCA Deutag acquisition, which brought a huge amount of new contracted work. However, it is important to note that a good portion of that international backlog, particularly in Saudi Arabia and the North Sea, comes from contracts that were recently acquired and might carry more risk. The report also mentions the early termination of a contract totaling about $35 million, which shows that backlog is not guaranteed income. The report highlights a bunch of risks, and honestly they need to. One of the biggest is the volatile nature of oil and gas prices, which directly affects how much their customers want to spend on drilling. If prices drop, so does demand for their services. Competition is fierce too, and there is often a surplus of drilling rigs, which drives down prices and squeezes profits. And in today's world, cybersecurity is a massive concern. They acknowledge that cyber threats, like ransomware attacks, could disrupt their operations, steal sensitive information, lead to lawsuits, and damage their reputation. Given how much their business relies on technology, a serious breach could be very costly. This is a big one. The report is very clear that integrating KCA Deutag is a huge challenge. They might not be able to make it work efficiently, and the benefits they hoped for from the deal could be less than expected, or take much longer to realize. They even mentioned contract suspensions right after announcing the deal, which is not a good sign for a smooth integration. This is where a lot of acquisitions fail, and HP Incorporated is making it clear they are aware of this risk. Now, this is critical. Their auditors, Ernst & Young, found a material weakness in HP Incorporated's internal controls over financial reporting. This means there is a reasonable possibility that a significant mistake in their financial statements could go unnoticed. The weakness is specifically related to how they accounted for the KCA Deutag acquisition, particularly in valuing rigs, recognizing deferred taxes, and allocating goodwill. Because KCA Deutag is so new to them, and they operate under different accounting rules, it is a complex area. The auditors themselves did not audit KCA Deutag's internal controls, which adds another layer of caution. Even though management believes the financial statements are fair, this material weakness is a serious concern about the company's ability to accurately report its financial health. Looking at the balance sheet again, you see that goodwill number $182 million, but remember a significant portion of that was impaired. Their intangible assets, which include things like customer relationships and technology, are also substantial at $485 million. These are highly subjective valuations and can be a source of future write-downs if the acquired business doesn't perform. The net loss of $163 million is a big number, highlighting the immediate impact of this massive acquisition. While revenue grew, the costs of integrating KCA Deutag, including transaction fees and those impairment charges, made it a losing year. They also self-insure a lot of their risks, meaning instead of buying full insurance, they take on a portion of the potential losses themselves. This is a common practice to save on premiums, but it also means they're on the hook for large amounts. If something goes wrong, their self-insurance liabilities are in the hundreds of millions. And while they have actuaries looking at this, it is still a significant financial exposure. HP Incorporated is also talking about sustainability and emissions reduction goals, which is becoming more important for investors. But they themselves admit that setting these goals and reporting on them comes with its own set of risks. What if they don't meet these goals? What if the technology isn't there? What if customer actions impact their reported emissions? This is a tricky tightrope they're walking, trying to appear environmentally conscious without overpromising or failing to meet expectations. So, what is the big picture here? HP Incorporated made a bold, massive move by acquiring KCA Deutag. On one hand, it significantly expands their global reach and diversification, potentially leading to long-term growth. On the other hand, the immediate financial results show the heavy costs and integration challenges involved. The auditors flagged a material weakness in their internal controls, specifically around the acquisition accounting, which is a serious concern about the accuracy of their financial reporting. Their domestic business is showing signs of strain, and the international segment, while growing fast in revenue, is currently losing a lot of money. The company's future success hinges heavily on their ability to successfully merge these two large operations, manage the integration risks, and navigate the volatile oil and gas market, all while facing significant new debt and investor scrutiny on their sustainability efforts. It is a high-stakes gamble, and investors will be watching very closely to see if HP Incorporated can turn this ambitious acquisition into a long-term win. Alright, that is our deep dive into HP Incorporated's latest filing. What is your take on this acquisition and the challenges ahead? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps the channel grow, and make sure you subscribe for more corporate secrets revealed. And don't forget to join the conversation and connect with fellow analysts on our Discord server, linked in the description. Thanks for watching, and we'll see you in the next Decode.